Hello everyone, welcome to our third podcast having to do with liabilities with some examples in Excel so that you can get some really good insight into how to work through these problems and hopefully complete your homework correctly. So first we're going to talk about term bonds and show the examples of the journal entry. So our first example, we have a term bond. Remember, term bond is interest only until the end or maturity. Coupon rate is 7%. Semi-annual interest is paid on April 1st and October 1st. The market rate or effective rate is 7% as well. And these bonds were sold on June 1st. So notice that we have a difference in the date between when it was sold and when it starts. The whole interest starts on April 1st. Okay? So the face value and maturity value is the same at $1 million, and this is going to go on for 10 years before we pay it off. Every 6 months for the next 10 years. So when we sell these bonds, we're going to sell them for their face or maturity value because the market effective rate is the same as the coupon rate. If we can get that to match, then we make the journal entry simply for the face or maturity value. We borrow exactly $1 million and credit the bond payable, debit cash. Now, because this started on April 1st and we didn't get it in the hands of the lenders until June 1st, then we're going to charge them the interest for those 2 months, April, May, and obviously June it's already there. So 2 months of interest at the 3.5 at 7% for 2 months is $11.67. Okay, here's your formula there in the thing. 7% divided by 12 multiplied by 2. That's going to be recorded as cash, additional cash received from we're going to borrow, and instead of being part of the bond payable, it's going to be interest payable. So they're going to give it to us now, and we're going to give it back to them when we make this first payment. And the reason we do that, it seems weird that they're going to give it to us and we're going to just give it back to them. But remember, the bond indenture is set. It says that on October 1st we have to pay the full $35,000. All right? So we can't change that part. So we have to do this little extra cash in order to make the whole thing work. So on the first payment, which would happen on October 1st, we would pay back their interest payable, this $11,000. So now we're even with the lender, and we're going to pay them the other interest expense for, you'd say, June, July, August, and September, 4 months. And we're going to give them a total of $35,000 in cash. Okay, so that's our first payment. Now, we don't have to worry about this $11,000 initial one. That was only at the beginning, and it's not going to crop up again. This next thing we need to worry about is our payment isn't until April, but on December 31st, we're doing our financial statements. And so we need to make an adjustment because what's happened, we paid our interest on October 1st, but there's been 3 months since then. October, November, December. 3 months of interest is $17,500 as calculated here in the formula. That is going to get us $17,500. We don't pay it. We simply record it as an adjusting entry, increasing our expense and increasing our current liabilities, interest payable. Then when we make our second payment on April 1st, we're going to pay back that payable and an additional 3 months, January, February, and March, interest to our lenders, $17,500 for a total cash. Notice the cash is the same every payment. All right, and record it that way, and we're good for the first two payments. We can basically do the same thing the next year, ongoing, except you don't have to worry about the 11,667. Now, looking at a similar example, but changing some of the terms. So our coupon rate is 7% again, but I put the dates on June 30th and December 31st. This time the market or effective rate is 8%, and we sold it on June 30th. So because June 30th is the same, the date we sold it is the same as it starts, we don't have to worry about this extra cash when we start the bond. All right? Face value and maturity value is still $1 million, and it's still 10 years. So those things are the same. Now, because the coupon rate and the effective rate is different, we have to use the present value calculation to know how much cash we're going to receive. It's not going to be exactly $1 million. It's going to be different. In fact, it's got to be less because we're paying less than the effective rate. And that means that those that are going to loan us the money are going to only be willing to loan us less than the $1 million. So to calculate the value of the amount we're going to receive, we need to do two steps with the tables, and then I'll show you how to do it in using Excel for the whole thing. So we go to the table, and I have those tables here for you to look at. This is the present value of an annuity. We go to the 4% column and the 20 periods, because it's 10 years, twice a year, right? And it was 8% effective rate, 4% for half a year, because that's when we pay interest every half year. Remember, you always use the tables with the effective rate, not the coupon rate. And so 13.59033 for the present value of annuity for the interest, and then we go to the present value of a single, go to the same place, 4%, 20 periods, 0.45639. You see, that's what we have here on the spreadsheet. So to get the amount of cash, we're going to take $35,000, the interest payment, times the present value of the annuity factor. Then we're going to add the $1 million times the present value of the single dollar factor. And that's what the formula is here in cash. Same amount for bond payable, so they're going to be equal under this scenario, just like they were over here, but for a different amount because of the different terms. Now, shortcut, you might say, is to do this in Excel with the whole thing quickly. You can use the PV function, equals PV, and then you tell it the interest rate, you tell it the number of periods, you tell it the payment, interest payment in the payment line, and then the maturity or face value in the future value FV line. Put those all in there and click on OK, and you see that we get a slightly different answer than if we use the tables, because the tables are rounded and this is not. But it's close enough. So we'll go ahead and use the number we have. All right, so calculate interest expense for the first payment on December 31st, 6 months in. We sold it on June 30th. We're exactly 6 months. Okay, we're going to multiply the bond payable times the effective interest rate, the 4% or 8% divided by 2. The cash is $35,000, just like it was over here, because the coupon rate does not change. That's what determines the cash paid, is the coupon rate. The difference goes to bonds payable. If it's a credit to make the debits equal the credits, then we credit bond payable and make it go up, which is what happened here. If it had been the other way and interest expense had been less than the cash, then we would have debited bond payable. Now, why don't we need an adjusting entry at the end of the year in this case? Well, we just paid it. We paid the interest on December 31st. So there's been no time to accrue interest between the time we paid it and the time that we do the balance sheet at the end of the year. Next payment. We take the original bond payable, subtract, or add, I should say, the bond payable we added to it here. So that's why it's important we understand that that's increasing our bond payable. So we add that and then multiply by the 4% or the 8% divided by 2 for interest expense. So interest expense is going up because the bond payable is going up. Again, the cash is the same regardless. And then the difference is a credit to bond payable again. And you would do the exact same thing for payment 3, except that you would add all of the previous credits. So if you imagine the T account for bond payable, the original credit was there, then another credit, it just keeps getting bigger and bigger. That bond payable is going to get to $1 million by the end of the 10 years. That's what has to happen for it to work. Okay, down here we have an installment loan. Remember, installment loan is different than what we've been doing there with the bonds, the term bonds. They had interest only. Each installment is paying principal and interest. So we borrowed $100,000. It's payable in 72 or 6 years monthly installments. And the interest rate is 3.25%. We always give that as an annual rate, even though this is a monthly payment. So the first step is to calculate the payment. Here is how you do that in Excel. You take the interest rate, you do the PMT function, or equals PMT. You take the interest rate, divide it by 12. Because we're doing monthly payments. If you're doing annual payments, you would need to divide by 12. The number of payments and how much you're borrowing. Click on OK and you'll get the payment. I rounded this, okay? So 1531. So borrowing the money on a loan payable like this with debit cash and credit loan payable. And then the first payment. Calculate interest as mentioned in the PowerPoint slides by taking the original loan payable times the interest rate, divide by 12 because we need to get how much interest for 1 month. The cash is the same each payment. The loan payable is how much is paid off, reduces the loan payable, the difference, always calculating interest expense first, the difference between what you paid and what the interest has to be paid. Next time, we subtract out the amount we paid off in the loan payable in payment number 1 before calculating the interest. The same way. Cash is the same. Loan payable is going up, right? Less interest. So the amount that the loan payable is going down, so the interest is going down, and so the loan payable amount is going up. And then finally, to make sure you understand, it's not just the last one, it is all of them. So we take the original loan payable minus the loan payable and the loan payable, all of the amounts that we are subtracting from the loan payable. Think of it as a loan payable credit, and then each time we make this payment, we're debiting that loan payable T account. And the total amount of that loan payable is going down each time. Cash always the same. Now, going over here to the finance lease, we'll see just how similar it is to an installment loan, but it does have a couple of differences. In this case, signed a lease on equipment that requires $1,500 per month. Okay, and I'll just tell you that it fits the qualifications for a finance lease. $1,500 per month lease payment for 6 years at 6% interest. So the time period is the same as that installment loan we did. All right. To record this lease and the asset, we calculate the present value, taking the interest rate they were given, the number of payments, and the payment. So this lease, this asset and liability is value is $90,509. We record that exactly like this. Notice with a lease, you're not going to have any. You're not going to have cash deposited in your account like when you did a loan. Okay, there's our recording of the asset liability for exactly the same amount. The first payment on a lease is usually made right away. Unlike an installment loan. Installment loan, you get to wait a month, and therefore there's interest on that first payment. On a finance lease, there's no interest on the first payment. It's all principal because no time has gone by. Interest is about time, so it's when no time has gone by. Second payment, calculate interest very much the same way as you did over on the installment loan by subtracting earlier payments and then recalculating it at the 6%, obviously a different amount of interest because we changed the interest rate from the installment loan. But just like the installment loan, the interest is going down because the lease liability is going down. That's how you work through all of those items.